Okay, and we are back. This is your live stream show for Thursday, October 25th, 2018. Decided to do it today instead of tomorrow. This week, U.S. stock market started to crack more. The Dow erases 2018 gains, and the NASDAQ crashed the most since 2011. Although today we had a little bit of a rally. Maybe there was dip buyers in there. Maybe there was people playing for a quick bounce. Maybe the plunge protection team was in there. No matter what your view is on why the stock market's bounced, as I discussed on last week's live stream show, I think there is a lot of evidence that institutional investors, the smart money who is managing a lot of money, is now selling rallies. They are fading rallies. There's just a lot of evidence of this. And actually, I'm starting to see from very smart financial professionals who write like paid investment newsletters, I'm seeing them and they're normally pretty bullish on stocks. They've been bullish on stocks for years. They've turned bearish all of a sudden. So very interesting. Of course, you have the contrarian indicator, Dennis Gartman, but a lot of people who were bullish on the stock rally for years and have made a lot of money on the way up in the general stock market, they've now turned bearish too. And there's a lot of evidence for this. You know, one of the things that was brought up was what Kyle Bass talked about in his Real Vision television interview. If you do not have Real Vision TV, it is $180 per year. I highly recommend it. If you cannot afford that, and still want to get Kyle Bass's insights, he did a 15-minute interview this week on Monday on CNBC for free. So you can watch that and you'll get a summary of some of the stuff. But he thinks a lot of the stock market sell-off has to do with what's going on in Italy and Europe. So we're seeing evidence that things in Europe are starting to spiral, especially Italy, because the new politicians in power in Italy, apparently there's an Italian Donald Trump and an Italian version of Bernie Sanders trying to figure out how to work together, and the only thing that they can agree on is they want the government budget to increase, despite, lack of tax revenue. Go figure, right, with politicians. But we are seeing evidence that, the market is worrying about Italy, and one of the things that we're seeing as proof of this is the dollar index. So I've talked about the dollar index at length now for months. I've done short videos on this. And the dollar index, when we're recording this live stream, it is at 96.6. So the dollar index has finally, after months of trying, gotten over that key overhead resistance level of 96. And now it's closed above 96 overhead resistance for a couple days in a row. And so, I've talked about this in the short dollar index videos earlier this year. And really, there's not a lot of overhead resistance for the dollar index. There was some at 96 and there was some a little bit more at 97. But once it gets through 97, it's going to head to 100 and potentially 102 very quickly. And that's going to do a lot more damage to emerging markets, holders of dollar denominated debt, Europe, etc. So, at 96.6 where we are now recording this live stream, I just do not see any evidence that the dollar rally has ended. In fact, it's the exact opposite. And I think a lot of this, like I said, the dollar index rally continuing is due to weakness in Europe. Because the dollar index is mostly made up of euro, Japanese yen, British pound, I think the Swedish krona. So the dollar index is not a very accurate measure of the dollar against a lot of other currencies. It's mostly against the G7. Okay, let me check my notes here and see. But the stock market did crack more this week. The NASDAQ had its biggest crash since 2011. I think it dropped 4.5% in one day. And the Russell 2000, the small cap index, was down about 2.5% in a single day. Now, they have rallied a little bit today. But like I said, there is institutions that are starting to fade this rally. And there's other anecdotal evidence that a lot of professionals are turning bearish now. And historically, October, if you go back through market history, October has tended to be the crash month. So whether it's October 1929 or October 1987, there has been a lot of stock market crashes in October. So I'm not saying for sure that we're going to have a much larger stock market crash. It's just from a historical standpoint, Octobers have tended to be less, well, it depends on your point of view. If you're short, then it's good for you. If you're long stocks, then that's bad. And another reason for why I don't think we're going to see a massive stock market rally until central banks maybe reverse course is that the financials are starting to break down. So since September 20th, the XLF, which is the financial ETF, that's a basket of like these large cap bank stocks and I think a few insurance stocks, and some mutual fund companies in there, like some large cap mutual fund companies like maybe Charles Schwab and Ameriprise Financial, I believe, that ETF has started to really break down. That was down when I was doing my show notes for this live stream last night. It was down 13% since September 20th. So and some of the individual stocks are down 9% in a short amount of time as well. So we are seeing, and normally in the past stock markets, there's very rarely an enormous stock market rally or a bull market going a lot higher without the bank stocks also doing well. Now, as you guys know, I don't like the banks very much, but from a historical standpoint, normally when there's a big stock market rally or there's a bull market in a lot of US stocks, general stock market indices, the banks also benefit from this. As much as we don't like them to, they benefit from this. It is what it is. Okay, so checking my notes again. Oh, and if you want to learn more about the banks and why the banks are not doing well, take a look at Christopher Whalen's work. He's written a bunch of books. He's a very smart guy. He's a hedge fund institutional level bank analyst. So I think his free blog website is institutionalriskanalyst.com. And he explains that despite, the Federal Reserve hiking interest rates, why the banks are not doing well. And, let's see here, the conventional paradigm is that when the central bankers raise interest rates, the banks should be able to have higher margins. They should be able to make more money off a sloping yield curve, but that's not the case. So go to Christopher, if you want a more in-depth explanation, Christopher Whalen has free articles on this explaining it. So for banks, it's all about the spreads. So and that's because there's problems in the bond market too. So not only are stocks cracking, bonds are also starting to crack. And if you look at a chart of the junk bond ETF, that's JNK, Janus, Nicholas, Kangaroo, that chart is starting to make lower highs. It's slowly starting to crack. It hasn't cracked yet, but it's slowly starting to crack. So banks, just because interest rates, the Fed has hiked rates, banks, large cap US banks in the US are not making profits like a lot of people thought they would because the spreads are just not there. The spreads are actually getting worse, and we don't have time for me to go into I'm not a banking analyst. We don't have time for me to explain it either. I would just direct you towards Christopher Whalen's insights there because he covers all these banks. He covers large banks, small banks, medium-sized banks. He goes to the banking conferences. He got insights from the European Central Bank. I talked about this months ago at a conference in Europe where there was disclosed that Italy's banking system has 30% non-performing loans. So I would go there. But, if you think that stocks are going to rally, with a strong dollar, with the financials starting to break down, there would have to be a lot more flight capital coming here to the United States from other markets, or the major central banks like the Federal Reserve would probably have to reverse policy. And we're not seeing that yet. So we're starting to see stocks crack even further. And there are a lot of people I know who are not libertarian, who are not limited government people, who are not Austrian school economists, and they're even starting to sell their positions on days that the stock market rallies. Okay, so let me check my notes some more. Okay, we talked about oh yeah. So I wanted to talk about Kyle Bass more. So he has some great insights. If you really have if you're already a Real Vision TV subscriber, definitely, and you haven't done so, definitely go watch. It's about an hour-long interview. And he talks in depth about his views on China. And the gold community and the alternative media, I think, are very pig-headed or wrong-headed. They're not willing to change their views. And to use a poker analogy, I honestly think that China has, at this point, overplayed their hand. Okay? I think China's credit bubble is out of control. Kyle Bass even says, and, there's going to be a ton of alternative media people that are just going to disagree with him, that are not going to even listen to his argument. They're not going to do any research. They're not going to do it. They're just going to say he's wrong or he's a moron. But Kyle Bass laid out the argument, and he said exactly why, that basically China has a dollar shortage, and China has burned through a lot of their dollar reserves, and China is in big, big trouble. He doesn't think China's going to collapse. He thinks China in the near future is going to have to do a RMB devaluation. Now he's been wrong about this for a couple years, but China is able to move liquidity back and forth through their economy, but there's only so much of this they can do. They can only kick the can down the road for so long. And he thinks that the state-owned that things are so bad in China that Chinese banks and other financial institutions, shadow banking entities in China have been calling up, I guess he has sources on this, have been calling up American investors trying to get American investment with dollars. So if Kyle Bass is right, then the argument that the gold community has said for years, that the alternative media has said for years, that China's going to crash the dollar, that the U.S. is no longer going to have any power soon, China's going to do a complete system reset, and the U.S. is going to lose everything, is totally wrong. So we'll have to see. But I'm just telling you, though, that I'm friends with a lot of people in the gold community, and they won't listen to anything anyone else says. Their minds are made up. They're very myopic. They will find it's confirmation bias. They will find the pieces of information that they need to find that fits their same argument. I still get messages from friends in the gold community telling me that in the next couple weeks or month or two that China with the Petro-Yuan contract, gold-backed Petro-Yuan contract is going to crash the dollar. I still get messages from that. And you know what? They won't listen to anything Kyle Bass has to say. Kyle Bass, I'm sure, is outworking them with research. Let's just put it that way. He spends all of his time on this from what it sounds like. And Kyle Bass is not a gold hater. Kyle Bass actually owns a lot of gold, and I believe he's the trustee for a large physical gold, and they took delivery of their gold. So he's, I think, the trustee for a University of Texas bullion fund, and they took delivery of all their physical gold holdings, and they're storing it themselves and paying insurance fees. And so he knows about, the problems with sourcing large amounts of physical metal. He just is, unless he's changed his views, I would just say that things in China, they've overplayed their hand. There's a massive credit bubble, and there's immense problems in China now. And there's problems in the U.S. too. I've discussed this at length with Louis Camersano. I think him and me are the only two people that are adapting our views that, things have devolved in China. Okay, so back to checking my notes. I will at the end of the live stream, I will answer listener Q&As. I just got to make sure I cover most of the topics that I want to cover. Before I forget, one listener on one of the other videos who donated $1 on my Patreon, so thank you for your contribution. Again, thanks to all 70 of my Patreon account contributors. I appreciate that. He asked for some more uranium market analysis, and what I would just tell him is that there's really less than a dozen uranium companies left, because basically all of them have had to survive a really, really hard bear market. And so the ones that haven't gone bankrupt, there's not too many juniors left. And the Energy Report, which is theenergyreport.com, all one word, URL, they cover a lot of the uranium juniors. So he can go there. It's a free newsletter, and they cover a lot of the juniors. But there's really, and again, this is not financial advice, stupid disclaimer. I forgot to do the disclaimer at the beginning of the show, even though I have it in my notes. And I forgot to thank my Patreon account contributors who are already contributors to 70 plus. So thank you guys for that. But there's only a handful of uranium producers, and the ones who are the largest producers have cut back on their production or stopped producing entirely. So uranium market, even though the spot price on uranium hasn't moved yet, the uranium shares have started to move. Cameco went from, I think at the end of last year, beginning of this year, from around $6 a share, it was like blood in the streets, and now it's at 11. So if you bought with blood on the streets in Cameco, you're already almost a double already per share. CCJ, Chris Jason. I think that's a very safe stock long term, because they have power plants. They're vertically integrated. In Canada, you're allowed to do that. So they mine the uranium, they refine it, and then they sell it as power at their power plants. That was very cheap, though, at $6. Congratulations if you bought it at $6. Oh, and also another piece of anecdotal evidence that's very interesting to me that I've noticed this week is that you have both Alan Greenspan and Paul Volcker coming out with books. So Paul Volcker published his memoirs a long time ago, but he has a revised version of his memoirs. He actually just did an op-ed, I think, in Bloomberg. Zero Hedge covered it in the last couple days, and he just blasted Ben Bernanke and Janet Yellen for their 2% inflation target, saying, you know, even 2% per year inflation is horrible, and it was going to have unintended consequences, and it was going to spiral out of control, and no self-respecting central banker should actually do that. And Alan Greenspan also has a new book out, probably because the surveys are saying people prefer socialism. Alan Greenspan has a new book out. He co-authored about capitalism, and he's talking also about stagflation, and he expects a market crash soon. So I think from an anecdotal evidence perspective, I think the reason that Paul Volcker and Alan Greenspan are both releasing new books is they both also expect another financial crisis or stock market crash in the near future. So those books should be very interesting. I'm not sure if they're on Audible. I know Howard Marks. People always ask me for book recommendations. Value investor Howard Marks has a new book out called like Understanding the Market Cycle, I believe it's called. And that's out on Audible audiobook. I didn't buy it yet, but I read his first book about value investing, and it was really good. He has a really respected value investing newsletter that he gives away for free. Okay, I'm going to take a swig of water. Yeah, so it'll be very interesting if the stock market does rally, if it can actually go higher without the financials. So if the financials are going to lag or continue to drop, that would be a big divergence, because normally with the way the stock market has performed in the past, the financials tend to also benefit. Even with the technology stocks, because the financials, the Wall Street guys were doing a lot of the financings for the Silicon Valley, for the garbage stocks. Wall Street made a ton of money off the technology bubble, selling garbage to retail and IPOing that stuff. So definitely take a look at the Kyle Bass interview. I think it's in opposition to what people in the gold and the alternative media are saying. So we had Tesla yesterday, surprise Q3 earnings. From talking with some, and this is why, even if you do fundamental analysis and you short stocks, this is again, not financial advice, how dangerous it is to short stocks, even with puts. But if you outright short stocks, it's risky because you don't know what the management team's going to be willing to do to move the stock price higher. And again, not financial advice, but if you're a more sophisticated investor or trader, or you're a hedge fund guy, if you're shorting and you don't have hedges in place or some type of insurance, if you're shorting like a stock like Tesla and you don't have calls with your shorts or with your puts, you know, you're taking too much risk, I think. And you don't have to buy that many calls, but if you were heavily short Tesla going into these earnings announcements, you got killed. But if you had calls as hedges, you probably netted out a lot better than people who weren't hedged. So shorting in general is dangerous because in the new environment we're in, I mean, people, a lot of times, publicly traded company CEOs, CFOs nowadays pretty much get away with accounting fraud. And from what I'm hearing, the stuff with the Tesla financials, first of all, Charlie Grant, Jim Grant's son at the Wall Street Journal, he covers the Tesla stock extensively, so he has good analysis on his tweets over there about Tesla. But Dave Kranzler, he has a master's degree in accounting from University of Chicago. He also traded bonds at Goldman Sachs for years. So he's a very smart guy. He knows accounting and GAAP accounting very, very well. He has degrees in it. And he was saying yesterday on Twitter after the Tesla earnings release, and by the way, Tesla reported like a GAAP profit and free cash flow. He was saying that Tesla, in order to cook the books this time, that they increased their accounts payable, and their accounts payable was already, I think, $3 billion. So that basically means that they're not paying their bills on time, anywhere near on time, and they have a lot of creditors, but that their accounts payable increased by another $500 million. And now I just saw earlier today that it looks like there's gains in the equity portion of the Tesla's balance sheet, that they added like $600 million in equity, but I think they only claimed about $300 million in net profit. So there's some weird stuff there. Weird stuff. But this goes to show you that, you know, people like Elon Musk or Jeff Skilling or whoever, or Elizabeth Holmes of Theranos, people are desperate. They're willing to do what it takes. And, you know, if Elon's just going to have to pay a $20 million fine, we don't know when these other charges are going to drop. From what I heard, one of my sources, a portfolio manager on Wall Street for over 20 years, this guy has good contacts. I speak with him a lot. And he said one of his sources in DC told him that Elon Musk has been meeting with his defense attorneys for an accounting fraud defense strategy like many hours a day for weeks now. So, you know, no official charges have been filed against him for accounting fraud yet, but, you know, in the meantime, they pulled this off with the Q3 earnings. It's very interesting. And he's not speaking super... I mean, if the earnings were real, wouldn't he have, like, gone into great detail about all the things that he had done to improve the company, improve the financials? It doesn't seem like he's talking that way. Just that, like, oh, we had record earnings and we don't want to talk about the details. Bye. It just seems that way. Yeah, so to add to the Kyle Bass points, I mean, I don't like Donald Rumsfeld. He's a neocon. I think he's definitely led the U.S. into a lot of wars, wasted a lot of money, killed a lot of innocent lives, both American soldiers and foreigners. But, you know, he did say this really good quote. This is probably the only thing I'll ever agree with him on. And he said, you know, about the world, you can put almost everything in the world into about three things. There's like the known knowns, the known unknowns. So things we have like a general idea about that we don't know, but we have a general idea about that we don't know, but we have a vague idea, or we can at least know which experts to ask. And then he said the third category is unknown unknowns. And so these are risks in the case of financial markets with the politicians, the central bankers, the government bureaucrats, the economic and political elites behind the scenes who will routinely change the rules. So, you know, as much as I know or other experts I interview know, we don't know everything. So we're just adding pieces to the puzzle here. Kyle Bass is probably one piece to the puzzle. The interview I did with Victor Sperandio a couple weeks ago, I think that's an interesting piece to the puzzle about the Treasury market, besides, you know, the stuff we already knew about the primary dealers. And the one about the unknown unknowns, I really think that the gold community and the alternative media just doesn't care about that stuff. You know, it doesn't fit their narrative. Their narrative is they need to figure out a story that says that the dollar is going to crash soon and that gold's going to go a lot higher. And you know what? They've been wrong for at least since 2011. Some people have been wrong longer than that. And most of the people in the gold community don't admit they made a mistake. You know, I made mistakes on gold calls in the past, and I've tried to learn from it, and I've read a lot more books and listened to a lot of other experts. I've tried to learn things from this. But I still read articles from people and see tweets from people in the gold community repeating the exact same thing that they have from basically 2007 to 2013 and 14. So here we are years later. You know, a lot has changed. Rules have changed. The European Central Bank wasn't supposed to be allowed to do quantitative easing. The Bank of Japan has done lots of QE. The Swiss National Bank has turned into a technology hedge fund. And the emerging markets have drastically overborrowed in dollars. China, in the last 10 years, has had a credit bubble explode to over 40 trillion US dollars worth of credit that they can't pay back. And the People's Bank of China's balance sheet is incredibly overleveraged. And the gold community and the alternative media is still repeating the same narrative. So I would like them, you know, some of them to actually adapt and admit they were wrong, and maybe admit that there's new information and that things are changing, and, you know, there's things that they don't know. But that's not how things work at the bullion dealers and a lot of the gold community. Props to Lewis, though. Lewis takes a lot of shit for it, though, but I think he's one of the best. He does have a stalker, though. The guy has, like, he told me the guy has, like, over 12 different screen names that the guy rotates on to harass Lewis on all of his interviews and all the videos on his channels. I mean, that's crazy. We're in a crazy world with truly desperate people, irrational people, people with mental illnesses. It's everywhere. Okay, checking my notes again, then going to take a water break. Okay, I think I covered pretty much everything that I wanted to talk about. That was actually fast. I got it done in under 30 minutes. I'm shocked. I didn't always say it perfectly, but I think I covered pretty much everything I wanted to cover already. Oh, there's the risk parity strategy. So Jeff Gunlock was talking about this, and it's a more sophisticated hedge fund strategy based off modern portfolio theory. And if you listen to the interview that I just released with Adam Tumerkin, and we talk about modern portfolio theory, and this is a stupid theory that everyone in business school or MBA program, or if you're a stockbroker, an investment advisor representative, registered investment advisor, whatever stupid title that you are, but you're selling stock and bond mutual funds. And with modern portfolio theory, basically, they have this stupid software with a modern efficient frontier curve, and whatever age you are, they enter that, and then your risk tolerance, and that's supposed to tweak it a little bit, and then that's supposed to give you the perfect mix of stocks and bonds. So if you're 40 years old, you're supposed to have, if you're 35 or 40 years old, you're supposed to have a lot more stocks and bonds. If you're older, you're supposed to have more bonds and stocks. You know, this is pretty cookie cutter. Well, the risk parity strategy is a more sophisticated version of this for hedge funds, and it plays off of this. And the risk parity strategy is starting to blow up now because we're having volatility in stocks and bonds together. So stocks and bonds are both cracking. And this is starting to blow up the risk parity strategy. And that's the tweet that Jeff Gunlock, the professional money manager, bond king guy, I think he also has a gold stock fund too. So he's not just bonds. He's a big gold stock bull. He has a separate gold stock fund. I saw his Real Vision TV interview earlier this year or last year. It's a good interview. If you have Real Vision TV, go back and listen. But yeah, the risk parity strategy is starting to crack too because of the volatility. And the VIX, when we're doing this live stream, is over 24 still. Any mining news? No, not really. There's not any major mining news. I mean, the mining companies need to merge. There needs to be mergers and acquisitions. The problem is a lot of these guys are not independently wealthy, so they need their high salaries from their jobs. And so they don't want to go fire, they don't want to take a pay cut, they don't want to cut their stock options, they don't want to fire some of their friends who are junior vice presidents or vice presidents. But, you know, the mining industry, if they were going to do the right thing right now, they would do some mergers with producing miners, and they would just slash selling general and administrative expenses, or SG&A. That's the last major cost that can be cut. There are not a lot of costs left to cut at actually the producing mines, because as I've done this at length, the price of gold and silver have to go substantially higher. Now, gold has had a rally, so gold and the dollar are higher. There has been money that has rotated out of stocks and into gold, and I think also into cash. That's also probably why the dollar's up. But weak euro now is definitely worrying people. The European Union, the stuff in Italy. Okay, so I think I've covered pretty much all the topics I have in my notes, and I can do some listener Q&A. But definitely, if you have time, go and read that Paul Volcker op-ed that came out this week. I think it's very good. He really takes Ben Bernanke and Janet Yellen to task. Okay, I will now start reading listener questions. I guess this show is going to be shorter since I actually was somewhat efficient, although I fumbled on the Kyle Bass interview about China. I mean, he goes into details about problems in China, some of the crazy stuff that the Chinese government is getting away with. And he was like, the Chinese government's, you know, 1 million people are going to re-education camps, or basically like what's the Soviet equivalent here? Gulag. The Soviet equivalent of Gulag. Still, he said like 1 million people, I think 1 million Chinese Muslims went to like a re-education camp. And he was like, and portfolio managers in the U.S. and Europe still want to buy Chinese bonds. He said that he brought this up and they don't care about it. And all that, he went into all these other details about problems in China, and he's like, no one cares. I think it's just there's just a general level. We've discussed this on Welcome to Dystopia and elsewhere. There's just a general level of apathy and lack of common sense now in society, especially American society. And I think one of my listeners, I think it was Kirsten, I think she even brought up mental illness. That like the level of undiagnosed mental illness would be high. You know, now also with I just saw this news story this week. In a combination of rising mental illnesses, there's also rising STDs here in the United States. So it's probably, that might be a blessing in disguise that I'm not doing too well on the dating apps with the hardcore Democrats, with the champagne socialists. That I'm avoiding the crazy STDs that are... I think some of these STDs have like doubled or tripled in just the last decade. Some of them. Not... I don't think it's HIV, but some of these lower level STDs, like, they've just exploded. It's really crazy. And Aldous Huxley talked about this in Brave New World. I mean, there was a lot of pretty good predictions in Aldous Huxley's Brave New World about people going on like prescription medications to numb themselves and distort reality, and then like all the like casual sex and stuff like that. I mean, he saw this. I think he wrote the book in around 1940. So he saw what was coming down the pipe. So not only Orwell predicted some of the stuff, but Aldous Huxley too. The dystopian fiction novels are pretty... I mean, some of the predictions in there turned out to be pretty darn true. Okay, back to your listener comments and questions, since we've wrapped up pretty quickly. 65% downturn in the cards from luminary winds. This is a sharp falling knife. We're all tied in together, the world that is. Yeah, maybe 65%. It's just a question of when and if the Federal Reserve is going to reverse course. I mean, at some point, I've talked about this, that the central banks will change the rules again. They will try everything else. They'll probably do more QE. It may or may not work because confidence may be distorted. There just may be too much credit bubbles bursting or derivatives problems or whatever. I mean, there's so many economic landmines out there that at some point, and the central bankers don't want to do this. They hate gold. They pay attention to gold. They know gold. At least most of them do. They hate it. A lot of them. And at some point, I think... it might take 5 years, might take 7 years. They will have to do what FDR did probably in 1934 because they will have tried everything else. And that's what I've called, and Jim Rickards called, I think, too, the financial nuclear option. And then, because the central banks will just not allow deflation. And Paul Volcker talks about this too. Paul Volcker in the op-ed, he talks about how, like, the central banks, even though there hasn't been real deflation for like 90 years, Paul Volcker said that the American central bankers are terrified of something that has not happened in 90 years, real deflation. So he said the central banks have done all kinds of stupid stuff and made things exponentially worse. It's too bad Paul Volcker's not running things. Although I think, you know, there would be a mutiny. There's also articles coming out that Ronald Reagan was threatening Paul Volcker too. So, you know, you have Trump talking, blaming the Fed now after he took credit for the stock market rally. But, I mean, there's precedent for presidents, whether it's Lyndon Baines Johnson or I think Richard Nixon for sure. There might have been a couple other Republican presidents like Gerald Ford. But then also Ronald Reagan, who yelled at Federal Reserve governors, told them, you know, you can't raise interest rates during an election year. You know, that's going to hurt my chances of getting reelected to the presidency. That's going to hurt the getting my political party either new seats or reelected in Congress, you know, all these threats. So it's pretty routine for that to happen for both political parties. But from a liberty standpoint, all this stuff, I mean, things, guys, have escalated so quickly here in the U.S. Look at the violence and the threats. Both political parties, all this stuff. I mean, who even... I don't know the truth about all this stuff that happened with these pipe bombs or whatever. I don't know. I don't know the details. I mean, I just saw the pictures on Twitter like you guys. But, I mean, things are escalating rapidly. And look how the mainstream media is responding to this. Look at the stupid comments from George Soros' son, because he's throwing a temper tantrum because all of his dad's plans are not going over as easily in the last couple years. Just ridiculous. But things are escalating rapidly. I don't know about where you are, but things in DC are escalating rapidly. I see just nasty comments in the comment section from some of these women on their profiles where, like, I've seen a couple of them. I haven't posted them on my Twitter feed yet, but a couple of them actually said that, like, if you don't agree that Brett Kavanaugh is a gang rapist, then I never want to speak to you. Like, I've seen stuff like that. You know, just people don't want to have a discussion. It's either my opinion or not, confirmation bias. It's really, really scary times. Totally dystopian. Okay, back to your listener comments. I went off on a tangent. Sorry about that. Listener questions and comments. If you want to tip me, that would be nice. A little quick tip here in the super chat. I'll answer your question first. Luminary wins. You think that this is no follow through today, just a dead cat bounce? It's certainly setting up that way from what we've seen with the financial newsletter writers who are smart people who have turned bearish all of a sudden, and also with the institutional investors that they're getting skittish too for many of the different reasons I outlined in last week's live stream, whether it's the dollar rally or problems in Europe or the volatility increasing with the VIX. There's a lot of different reasons for institutional investors to want to sell their shares. Okay, reading another comment. Daniel Garcia. Martin Armstrong has been saying for years that Dow is heading to 30,000, and I believe him now. Well, it's a question of timeline. And also, like, what's a dollar going to be worth? So we don't, I mean, if the Federal Reserve is going to do a lot more QE in the next couple years and drastically devalue the dollar, then asset prices will probably have to go higher. But then you're probably also at a mediocre restaurant going to be paying like $25 or $30 for a chicken dish or for a pasta dish at a mediocre restaurant. And then you're going to be paying over $50 at like an Outback Steakhouse or a Longhorn Steakhouse, over $50 for a steak. And then at a fancier steakhouse, you're going to be paying even higher. Government won't allow asset and pension funds to fall. There's too much at stake. Well, here's the problem, Daniel. Even if the asset prices go higher, there is still no mathematical way for the pension funds, whether it's in the United States, different states in the United States, at different levels in the United States. And I've said this too, the politicians who made these promises to get votes, to get elected, to get reelected, they should go to prison. They lied bad. They committed fraud, like egregious fraud, making these promises to get votes. They should be held. I'm finishing up Nicholas Nassim Taleb's book. I highly recommend it. I've read Fooled by Randomness. I've read Black Swan, and I'm finishing up Skin in the Game. There's a couple more books of his I haven't read. I have Anti-Fragility bought. I didn't read it yet. But he says skin in the game. There's no skin in the game. There's no repercussions to the politicians making these lies. Okay? The politicians, for making lies this egregious, for promising people this type of retirement, like a cushy retirement for votes, for that type of lying fraud, they should go to jail. There should be skin in the game for them, so they shouldn't lie. So society has not aligned things properly. See, I'm already applying the things I've learned in Nicholas Nassim Taleb's book, Skin in the Game. That guy, I saw him speak at the Ron Paul Institute conference. He's very Socratic. He's very, with the way it seems he just enjoys pissing as many people off as possible. I think he's like giggling on the inside while he talks. He seems very serious, but I think on the inside, I think he's giggling at everything he says while he makes fun of people and criticizes everyone. All different types of groups. Yeah, so back to, got a little off tangent, but yeah, with the pension funds and the asset promises, even with higher asset prices, they still can't meet their obligations. Okay, that's the point I want to make. Even if Dow 30,000, Dow 40,000, real estate prices go up 30-40%, bond market stay in a bull market, all of those things are unrealistic for those things to stay higher and go higher over a short period of time without any type of volatility or crash. And still, Daniel, pension funds are way short. So that's how bad. And I saw an article, I think it was earlier this year, that globally, so not only is it the US government, it's also in Japan, it's also in Europe, it's all over the globe, that globally there is over a $500 trillion pension fund shortage by like 2050. Okay? So if there is like a debt jubilee or reset, I mean, ideally what should happen with the pension funds is they're going to have to admit that they can't pay it back. But first, I think they're not going to do that first. It seems what's going on first in California is you're having stuff where CalPERS and CalFERS, which are the two largest pension funds in California, to try to meet some of the shortfalls because they are supposed to get 8% per year compounded, and they're not. I don't even know if they're getting 1% recently, despite the asset price inflation in the bull markets, artificial bull markets in these asset prices. And so they went to Sacramento, the two largest pension funds, government employee, either teachers or California government employee pension funds in California, and they asked for taxes. They want to layer more taxes on from California residents or tourists in California to meet the shortfalls, to help meet the shortfalls. Well, that's not a good strategy either, because then you're going to have productive businesses and middle-class people in California want to leave the state. They're not going to want to. Look, if your income's not rising, You're not going to want to pay more taxes. I mean, you'd have to be a moron. I'm sorry. I'm sorry. If maybe some people can't leave the state, okay? So, but if you have common sense and you know that you're going to get taxed more to death and you can leave, you either have savings or you can transfer your skills or your company can allow you to transfer your company's moving and you can move to another state. If they're going to increase your property taxes by $5,000 or $10,000 a year and your income's not rising, and they're going to layer on, you know, new food taxes and gas taxes and all this, and I have friends now who are paying like $1,500 for a car tax here in Arlington County, Virginia. I mean, and I've heard similar stories about how car taxes per year have exploded in Las Vegas here in Nevada. And Nevada is considered a low tax state. Well, there's exploding taxes on cars there for driving. So what you have people in Las Vegas, from what I've heard, is you have a bunch of people trying to cheat that law to not pay taxes there with out-of-state plates, so they won't switch over. So I'm sure it'll be a cat and mouse game, and Las Vegas will switch. We'll start finding people then. They will like save license plates from foreign areas and save them in their database. And if they can tell that you've been driving around in their state for 30 days or longer, they're going to start issuing like $500 fines. This is just how the government works, man. Unfortunately, and this is Orwellian, this is dystopian, the new normal going forward is going to be more inflation and more taxes. I wish I was wrong. But, you know, in most of our lives, the prices of many things are going to go up, and the governments are going to figure out new ways to layer things on. And it's a new normal, and it freaking sucks. It's been going on for a while, but my point is that it's going to start accelerating. Because if asset prices fall, you know, even in Italy, despite the problems in Italy, they should be cutting back on their government budget. And here you have the new politicians that were elected, and the Italian citizens want radical change, and the politicians basically agree that they want to spend even more money. And you have basically an Italian equivalent of Donald Trump, an Italian equivalent of Bernie Sanders, and they still agree that they want to spend more money. Real inflation is approximately 10%. Yes, in the United States, depending upon which city you're in, it's been 10% per year for a very long time. There's actually the Chapwood Inflation Index that Ed Butowski runs. It's free. You can check it on there. And he surveys a bunch of major cities in the U.S. every 6 months, so twice a year. And he asked people to fill out like 500 consumer items. So he surveys like thousands of people, and he's been saying that inflation has been between 9 and 13% in many major U.S. cities for every year for a very long time. Which means that like your standard of living, if it's a 9% inflation rate, in 8 years, your standard of living is going to be cut in half. That's the rule of 72. So if you're taking like the stockbroker test, the Series 7 or the Series 66, they ask you about the rule of 72. So that's a doubling rule. It's a quick way to figure out doubling percentages. Yeah, I mean, there's going to be more inflation. It's going to be layered on. It's the new normal. Grumpy Troll, I don't understand your comments about uranium. I took a little break too, Grumpy Troll. I did an interview with Adam Tumurkin last week. Unfortunately, there were some editing problems, but I got it released today earlier. So hopefully you'll enjoy that. I think it's a good interview. Really good. He's a really smart, bright young guy. I think he's like around 30 years old. I've known him for years, so he's been reading and learning since about investing since he was in high school. He's very sharp. Yes, I know about the RR. Yes, I know about the broken Eurodollar system. I've answered this many times in past live streams. I've talked about this at length. The Eurodollar system, RR, is just one piece to the puzzle. Jeffrey Snyder of Alhambra Capital Partners talks about it a lot more. The Eurodollar system is not the largest economic landmine. It's not the largest economic landmine. The largest economic landmine in terms of pure size is the whole over-the-counter derivatives markets. Although the pension funds now are there's the pension fund liabilities that all these governments have promised is also a problem long-term. But the governments don't think long-term. So, I mean, like most of these politicians are just looking for short-term solutions to the pension fund problems. No one has a long-term solution to the pension fund problems, to the lies and the false promises that the politicians have given. But the Eurodollar system, that was papered over by what the central bank to central bank doing currency swaps. So there's no transparency in this. We only found out about this at all because of the one-time partial audit that Ron Paul was able to get while he was still in Congress, with Republicans, including John McCain, and Democrats, including Bernie Sanders, to actually agree on a one-time partial audit of the Federal Reserve from the Government Accountability Office. And we found out that in about a month time span, at the height of the 2008 financial crisis, that $16 trillion in basically interest-free loans and currency swaps was given out to the European Central Bank, foreign governments, foreign central banks, foreign banks, even American corporations. And we don't know how much is still out there, but from the sources that I've been told, and I've talked about this at length since 2014 when the information was brought to me, that the currency swaps have been ongoing in Europe. They never really stopped since 2008. Sometimes it's a lot, and sometimes it's not, a little bit, and sometimes it's a lot. In this case, I mean, Trump earlier this year in the summer to even, I'm not sure if he was joking or not, to even talk about the U.S. government buying Italian bonds was pretty telling to me. To even like bring it up in public and kind of joke about it. I mean, I think Trump was actually briefed on how bad Europe is, the European Union, how bad the European Central Bank is, how bad the European banks are, the government debt problems with the European Union. I think Trump was actually briefed, and I think that's why he even brought it up in public, to test it out what people would say. It was kind of a trial balloon. So I think Trump is aware that the U.S. is basically keeping Europe on life support. Like, I brought this up that, I mean, China sells so many goods into Europe, and the U.S. needs Europe as a trading partner, that I would not be shocked if the U.S. and China were already discussing how to bail out Europe. I mean, we're in a new normal here with coordinated central bank intervention. At least there was intervention for a number of years during and after the 2008 financial crisis, and central banks changing the rules. So I would not be shocked if the U.S. and China are already discussing what to do about Europe and how to bail them out. I'm not saying it's right. As a libertarian, limited government, sound money, hard money type of person, and I don't like central banks, I want them gone. I don't think it's right, but I don't have a vote in the matter. Welcome to the live stream, Zeffy, second different spelling, Zeffy. Aaron Hawley, can we call our current system capitalism if we don't have free market interest? No, we can't. We can't really call it capitalism, but we can't call it full socialism either. It's kind of like a variation of fascism, but there are some small pockets of free markets in capitalism. If you're a small business owner, Aaron, you don't get bailouts. You don't have lobbyists bending over backwards to help you out, like skirt rules and regulations. So it really depends. There is some free market forces and some capitalism. So in certain technology industries like flat screen TVs and laptops and stuff like that, prices are falling. There's more competition. Consumers are benefiting. But yeah, we don't have real capitalism. It's very similar to what Richard Duncan called creditism, although Richard Duncan's solution, and I've interviewed Richard Duncan a number of times over the years, listened to his interviews, his solution, and I'm using air quotes, is that the central banks should actually coordinate and go for broke and actually increase their QE by many, many trillions of dollars, but he's saying that they should use it smarter than the QE they've done before. So rather than bail out bankers or protect the derivatives market or whatever, that the central bankers and the governments instead should focus on infrastructure and should throw like, I don't know, $1 trillion at robotics, or $1 trillion at 3D printing, or $1 trillion at stem cell therapy. You know, I'm just, you know, or $1 trillion at tens of trillions of dollars at space technology, so we can go colonize another planet and Elon Musk can go do his fraud on another planet. So that's Richard Duncan's solution. And Richard Duncan is saying that that's the only way to avoid like another world war. Maybe he's right. I don't know. Maybe he's right about avoiding another world war. Because the US and China seem to have with the strategy that Trump is doing, and Kyle Bass talked about this, that basically, in Kyle Bass's opinion, there's a bunch of estimates out there that China has been stealing between 200 billion and 600 billion per year in research and development, innovation, and intellectual property. So China would manufacture cheap goods, but there was technology transfer, and China was stealing all this value-added innovation that the U.S. was coming up with. And so that's hurt the U.S. economy for the since China joined the WTO, and apparently China has violated all their rules. They were supposed to meet certain criteria for joining the WTO, and they haven't done any of this stuff. Okay, I totally lost my train of thought there. I need a little break and grab a swig of water. Daniel Garcia. Yeah, there's at least 5 or 6 plunge protection teams. 1 or 2 of them might be academic, though. Pippa Malmgren was on one of the academic ones. She said that there was no trading screens or anything like that, but we do know in the New York Federal Reserve that there is a bond trading and derivatives trading division, because people have seen on LinkedIn that people have jobs there for derivatives desk and trading and stuff. And I believe the New York Fed also gets discounts at the Chicago Mercantile Exchange doing certain types of trades. They get a volume discounts. So there is a lot of anecdotal evidence that there is massive intervention. But, you know, the average person on Wall Street, a lot of people on Main Street who do not see the world the way we do, would not believe any of it. And Trump does want a weaker dollar. The problem is that the emerging markets are in trouble. Nothing's been fixed there. They got too greedy. They borrowed too much dollar-denominated debt. They shouldn't have done it. Europe's a mess. So what's the dollar going to be devalued against? So if you have all these other currencies and economies that are not doing well, and you know the U.S. stock markets are cracking this week, but as I've talked about this at length, stock markets in other countries are doing even worse. They've been doing worse for a year, basically. You have all the other major stock markets outside of the U.S. that are below their 50 and 200-day moving averages, and they're going lower. So on a relative basis, compared to other currencies, the dollar is stronger. On a relative basis, compared to other stock markets, the U.S. stock markets were doing better, and that's why more money was coming here as like a bastion, like a safe haven, flight capital, similar to the last 2 years before the October 1929 crash. So all the other, if you're not familiar with financial history, pretty much all the other major economies all over the globe were in major depressions already prior to October 1929. And the U.S. had technological innovations with the radio, refrigerators, some other technological innovations. U.S. was the leading manufacturer of cars and steel then too. So there was tons of people chasing that. The U.S. also had an enormous property bubble too then with in Florida. So there was swampland being turned into like condos, and a lot of money came into the U.S. from other countries prior to the October 1929 crash. So it's similar. History doesn't repeat, but the Mark Twain saying is it does rhyme. And we are seeing, in my opinion, similarities to the 2 years before the October 1929 crash playing out. Now, I don't know if we're going to crash for sure, you know, in October, but probably I would say it could happen easily by the end of next year. It might even happen sooner than that. Things are starting to break in a lot of other areas. And you could have one last maybe blow off here in the U.S., and then that might be it. Perhaps. No more world wars. The big nations will only fight proxy wars. Hot wars between great powers are too costly now. Maybe, but the thing is, though, that President Trump is really adamant about this trade war, and he's adamant he can win it. I'm hearing people say that the U.S. can win the trade war, and it's not going to cause that much pain against China. But it is starting, at the minimum, it's starting a new Cold War between the U.S. and China. And that Cold War, it can escalate. So we'll have to see. Nave Child, Fukushima joke. Oh. Andrew, I am Mateo. Come to Anarchapulco. That sounds fun, but I honestly don't have the money right now. So sorry. If someone wants to pay to bring me down there, that would be cool. But I probably need to buy a new laptop with my Patreon soon. That would be a more practical purchase. RGN, are you going to go long Deutsche Bank? No, please don't go long Deutsche Bank. Maybe it'll have a dead cat balance. I mean, the Deutsche Bank, the German government's already talking about merging Deutsche Bank and Commerzbank, and Commerzbank is leveraged 40-1, even though they don't have the derivatives book problem that Deutsche Bank does, but that's not going to end well. I mean, maybe you can make a quick profit. It's kind of like, I guess you're trying to do like the people who are buying like Fannie and Freddie stock on the pink sheets when they were below $1. And some people were day trading that stuff on any press release that like Fannie and Freddie were going to get extra capital injections or a bailout or the accounting rules were going to change on them. And there would be quick spikes in the stock. But that's just not worth it to me. I'm not a day trader like that. That's just not something I want to do. Alex Grant, after hour fangs are tanking, undoes the whole day. Well, actually, Alex, in the Wall Street for Main Street Facebook group, there was a good chart I posted. I think it was from either Fred Hickey or Jesse Felder in the last week or so. And they had a chart of Facebook, Amazon, Netflix, and Google. And the long-term chart on that since 2012 had already broke below its uptrend line. So it had broken below key support levels already on the trend line. So that chart had already broken when I looked at it last weekend, I think it was. So that chart, maybe there was some buying that came in and moved it, but it had already broken below the trend line. So maybe there was some buying that came and moved it back up. Michael Barker, you want comments on New Gold? I haven't seen any new press releases on New Gold lately, but New Gold, their shares were below $1, and that is always bad for a publicly traded company, especially on a major U.S. stock exchange. There are big rules for pension funds, mutual funds, institutional investors. They are not allowed to hold stocks below $5, let alone below $1. So that forces automatic selling. Okay? So even if nothing changes operationally at the business, if the share price of a company drops below $5, a pension fund or a mutual fund that has a lot of shares of a stock, in their bylaws, they may have to sell it. Okay, and so New Gold does not have long-term buy and hold institutional investor support anymore. Even from probably Canadian mutual funds and Canadian pension funds cannot buy and hold New Gold anymore. So what I would think is going to happen is New Gold is running out of options. They can either, I don't know what their debt payment is and when it's due. I know they have a lot of debt. So they can either sell their assets for pennies and try to pay back the debt, but if they don't have the cash flow, that's bad too. Or they can do what will probably happen, because the mining industry is notorious for this. Coeur d'Alene CDE has done this for many years, is anytime a mining company gets in real bad trouble, they try to do a reverse stock split and start the dilution all over again to save themselves. So if New Gold tries to do a reverse stock split, say at 10-for-1, they would hurt their share. So a reverse stock split by itself is not bad. It doesn't change the market cap, but normally it's what you do with the reverse stock split. So are you doing a reverse stock split to go from like $1 a share up to $10 a share so you can list on a major exchange and then not dilute your shareholders? Or are you doing a reverse stock split to start dilution all over again? And Coeur d'Alene has a long history of avoiding bankruptcy with share dilution. And the CEO doesn't get fired. CEO still gets stock options. CEO still gets paid a high salary. So if I were to give an educated guess, and this is not financial advice, again, stupid disclaimer, I don't want suits and badges coming and saying, Jason, why did you talk about New Gold and all this stuff? I'm just explaining about reverse stock splits. So New Gold, as if you're running a publicly traded company and you're on a major stock exchange and your share is below $1, you are in major trouble. So they're discussing how to get that stock price above $1, and I can almost guarantee you that the most easiest way will be a reverse stock split. Unfortunately, normally with reverse stock splits, especially given their balance sheet and their precarious situation with New Gold, and maybe they can turn things around operationally a couple of the mines, that the most likely course of action is reverse stock split, then probably dilution. They may also go bankrupt. If shareholders, the shareholders have to vote. So the largest shareholders have to approve the reverse stock split. So if they vote no and they want to go into bankruptcy and they want to kick out the management team, they want to regain control of the company and bring in new managers, then they would vote down the reverse stock split. But a lot of shareholders tend to vote in favor of at least one attempt at a reverse stock split. So I would not want to be holding that stock with a reverse stock split, because probably the dilution will start again. But, you know, long-term healthy for the company, it probably has to be restructured, but normally that's not what the management team wants to do, because in a restructuring, the management team could be kicked out. So normally, in order to stay at the company, the management team will take the path of least resistance, the one where they can stay and still get a salary and stuff and potential stock options. And normally that's a reverse stock split first. The mining industry is famous for reverse stock splits. And most of the time, reverse stock splits are not good. But sometimes they can be all right as long as the management team does not do massive share dilutions and repeat the cycle over and over again. Nave Child, the stuff you brought up is very interesting. Some of it could be false flags. I don't know. I really don't. But I do know that violence is escalating, and I do know that unlike most Republicans, although some Republicans are starting to grow a backbone now, Trump is bringing a new type of fight and street fighting to a lot of Republicans. I think you're going to see, because it's effective and he's winning elections, you're going to see a lot more Republican candidates run similarly to Trump and be willing to fight back and not apologize. You know, there's going to be less, I think, Mitt Romneys now going forward, where the Democrats could just walk all over them. But Democrats are willing to, not all of them, because there's some moderate Democrats and there are some nice Democrats out there, although not a lot of them. But there are some Democrats that are willing to do anything to win an election, to gain political power, to, you know, destroy their opponent, to accomplish whatever it is their agenda, whatever George Soros and the other key decision makers decide is the agenda for the week or the month of the year. But they are encountering legitimate resistance. And that's why you're seeing comments from George Soros' son, Alex, because he's a whining little baby now, even though he has a lot of money. He's a whining little baby complaining because they're not as easily accomplishing all the stuff that they were even 2 years ago or 3 years ago. Alex, you think U.S. will confiscate gold or make gold transactions illegal? Well, I think you should be diversified. So if you have gold money or some of the other bullion dealers that you can store physical metal outside the U.S., you can store it in Toronto, you can store it in Hong Kong or Singapore or Switzerland. That's why, ideally, if you have the resource, and this is not financial advice, this is just my opinion, for diversification purposes, if you have the capital to do so, you should have some bullion stored in at least one or two other countries, just for diversification purposes, just in case of that. Look, Alex, man, we don't know what the politicians, how desperate they're going to do, how they're going to change the rules. The U.S. already has tax laws in place that do not benefit long-term capital gains on holding gold and silver. So if you bought silver at $4 an ounce 10 years ago, actually more than 10 years ago, that would be about 15 or 20 years ago. So if you bought silver when it was $4 an ounce in the late 90s, early 2000s, you do not have any long-term capital gains tax benefits from holding it 20 years. So when silver, if you had long-term capital gains tax benefits, and if silver went from $4 up to $50, and you only had to pay a 10% tax, and you sold some of your silver then for a profit, could have locked in the lowest tax rate. But the U.S. government has intentionally tax silver as a collectible. I would take a look, Alex, at the articles that Daniel Amerman, Daniel Amerman, he's a CFA, and he actually helped design some of the mortgage-backed securities on Wall Street before he left. And he called the 2008 financial crisis in advance, and he warns people about putting all of your money into gold and silver. And he discusses the tax ramifications in detail, showing as gold goes to 10,000, all the taxes you're going to have to pay on it. I'm not saying not to own gold and silver. I'm just saying if you put all your money into gold and silver as an American, that the government can change the rules on you. So it's already not a... There's not a tax benefit for long-term capital gains taxes on gold and silver, but they could do even worse. They could, you know, do what FDR tried to do in 1934 with the gold penalties. They could also put a windfall profits tax. Congress discussed in the 1970s a windfall profits tax on the oil companies when the oil price rose. So in the new normal, Alex, you're going to have to be adaptable. I know it sucks, man, but if you have the resources to do so, you're going to have to probably have gold and silver stored in at least 1 or 2 other countries. And you're going to have a plan in case, you know, windfall profits taxes or other things. And you're going to have to pay attention to the tax laws. So one of my listeners did travel to New Zealand recently, and he said that so far New Zealand did not enforce, at least for him. So this anecdotal, it's not guaranteed that they're not blanketing enforcing yet. But he said that they're not enforcing for him the fine, the massive fine for giving them your smartphone password. But it sounds like eventually, maybe 6 months or a year from now, New Zealand, if you fly into their major airport, that they're going to try to fine you if you don't hand over your password. They want to look at your crypto, see if you have any untaxed crypto they can steal. And, you know, there's no easy solution. The world we're in sucks. And a lot of lawyers are in charge, or people who have a lot of money can hire expensive lawyers to change the rules. And this is why I talked about on the Welcome to Dystopia episode, the recent one, episode 44, moving the goalposts. Do you think I like that? Do you think I like being Charlie Brown when Lucy keeps pulling the football? No one likes that. Well, unless you're the person that's like pointing and laughing at Charlie Brown falling on his ass, right? As long as he doesn't get a concussion or CTE. Java Junkie, will Fed raise interest rates in December? They're saying they want to. I mean, it doesn't... If the markets crash, then maybe they won't. But Lil Brainerd has said they don't care about inverting the yield curve. So we'll see. To me, Java Junkie, I know this is kind of evasive. I honestly don't care. I honestly don't care because you know what? Things are starting to crack. And the most likely suspects for the next problems, educated guess, are like European banks, corporate bonds, and emerging markets. So whether the Fed decides to hike rates or not, those 3 major economic landmines are still problems, okay? So whether the Fed hikes rates or not, those 3 economic landmines I talked about are still big problems. They're not going away. Okay, guys, well, I'm getting pretty tired here, and I think I've answered most of your listener questions. The chat here in the live stream is slow with the comments. So I'll answer, if you have other questions or comments, type them in the comment section after the video is archived. And I'll try to get to them there later. Because I know you guys in the chat sections, you put a lot of questions and comments there, and I honestly don't even see most of them. I think it's working at like half speed here. So just copy and paste your comments into the comment section below after this video is done. But I'm good for right now. So I'll wish you guys a good weekend. Hopefully the Dodgers will come back. If they don't win tomorrow, I mean the series is over. But as a Dodgers fan, you know pain. So good teams, not great teams. We win the division, we go to the playoffs, and then we win one series or so, and then our hearts get broken. So as a Dodger fan, I'm kind of used to this type of torture. As a Washington Capitals fan, I was used to it too. But then look what happened to the Capitals this past summer. Got lucky. I mean, no Capitals fan thought that we would actually make that type of run and win the Cup. I mean, people were skeptical the entire way. The Capitals almost even got eliminated in the first round, and then before they turned it around. So we'll see what happens. That's why I love sports, man. I mean, it's unscripted drama. Although there are people, conspiracy theorists, saying that like the NFL is rigged and stuff like that. I mean, the officiating's just bad, and the rules changes in the NFL are making it bad football. And in the NBA, people, the NBA referees, the star players get ridiculously preferential treatment. It's stupid. Okay, well, I went on my sports rant. I'll stop now. You guys are here for market analysis. Maybe I'll have to set up another podcast channel for that. Okay, guys, good night.